Hello, viewers. We're back again presenting the top news and events in the global economy and financial. This week delivered a major shift in the U.S. macro outlook. Oil prices fell as investors grew optimistic that a U.S.-Iran agreement could eventually restore energy flows through the Strait of Hormuz, easing fears of a prolonged supply shock. At the same time, U.S. consumer sentiment improved for the first time in 4 months. Retail sales beat expectations, and jobless claims remained low, pointing to an economy that continues to show resilience despite elevated uncertainty. However, the Federal Reserve stole the spotlight. Policymakers left interest rates unchanged at 3.5% to 3.75%, but surprised markets with a more hawkish message. The Fed raised its inflation forecast and indicated that roughly half of officials expect at least one more rate hike before year-end. Adding to inflation concerns, import prices recorded their biggest increase in nearly 4 years, driven by lingering geopolitical disruptions and surging demand linked to the AI-driven data center boom. Meanwhile, manufacturing output stalled, private credit defaults reached a record high, and tariff tensions intensified as the U.S. launched a new investigation into Germany while courts allowed existing tariffs to remain in place. For investors, the key takeaway is that the market narrative has shifted from recession fears toward inflation persistence. While easing geopolitical tensions have supported equities and reduced pressure on oil markets, the prospect of higher for longer interest rates is likely to keep volatility elevated across bonds, commodities, and risk assets in the months ahead. China's economic recovery is showing increasing signs of strain as fresh data revealed a growing divide between the country's export sector and its domestic economy. Retail sales unexpectedly declined for the first time in more than 3 years. Investment activity weakened, and tonal social financing fell over 11% from a year ago, highlighting soft consumer confidence and subdued private sector borrowing. While industrial production accelerated thanks to resilient exports and strong global demand for high-tech goods, the broader economy continues to struggle under the weight of a prolonged property downturn and weak household spending. In response, Beijing is rolling out a series of measures aimed at strengthening growth and expanding China's financial influence. The People's Bank of China signaled a potential shift toward an overnight policy rate framework, while also launching new yuan liquidity facilities for foreign central banks in an effort to accelerate the internationalization of the Chinese currency. At the same time, policymakers unveiled an employment-focused 5-year plan that includes monitoring the impact of AI on jobs, while regulators pledged greater support for AI companies seeking domestic stock market listings. However, China's external environment is becoming more challenging. The G7 agreed to reduce dependence on Chinese critical minerals, while global supply chains continue to diversify away from the mainland. Although China is deepening economic ties with Africa and expanding yuan usage abroad, the domestic economy remains the key concern. For investors, the message is clear. China's growth story is increasingly being driven by advanced manufacturing, technology, and exports, while consumer-facing sectors and property-linked industries continue to face significant headwinds. Europe is entering a new phase of economic and strategic policymaking as officials grapple with rising inflation risks, growing trade tensions with China, and increasing concerns about financial stability. The European Central Bank has signaled that interest rates could rise further, despite progress toward a U.S.-Iran peace agreement, with policymakers warning that elevated energy costs are starting to spread throughout the broader economy. Adding to those concerns, the ECB expects wage growth across the euro area to accelerate in the second half of the year, potentially complicating efforts to bring inflation sustainably back to target. At the same time, European leaders are taking a tougher stance toward China. EU officials are debating measures to reduce the bloc's growing trade deficit and dependence on Chinese critical minerals, while the European Commission is reportedly preparing countervailing duties on Chinese hybrid vehicles. The shift reflects a broader effort to strengthen Europe's economic resilience and reduce strategic vulnerabilities across key supply chains. Meanwhile, regulators are moving to bolster the region's financial system. Brussels is considering reforms that would streamline bank capital requirements and potentially unlock additional lending capacity, while the ECB has expanded its scrutiny of banks' exposure to the rapidly growing private credit sector. Combined with calls for greater cross-border bank consolidation and increased government spending on defense and infrastructure, particularly in Germany, Europe is increasingly prioritizing economic security, industrial competitiveness, and financial stability. For investors, the region presents a mix of opportunities in defense, infrastructure, and banking, but persistent inflation pressures and escalating trade frictions suggest volatility is likely to remain elevated. Canada is increasingly positioning itself between a more protectionist United States and a rapidly changing global economy. Prime Minister Mark Carney has been strengthening ties with Europe, meeting with Emmanuel Macron ahead of the G7 summit and agreeing to deepen economic cooperation. The move reflects Ottawa's broader strategy of diversifying trade and investment relationships as uncertainty surrounding U.S. trade policy continues to linger. Domestically, policymakers are taking steps to support investment-led growth. The Office of the Superintendent of Financial Institutions reduced capital requirements for Canada's largest banks for the first time in 3 years, a move designed to encourage lending toward major infrastructure, defense, energy, and artificial intelligence projects. At the same time, the federal government announced more than $1 billion in measures aimed at increasing competition in the grocery sector and tackling persistent food inflation, while also proposing tougher privacy rules that would give consumers greater control over their personal data. Economic data paint a mixed picture. Retail sales rose 1% in May, largely due to higher gasoline prices, but underlying spending remained soft as core retail sales declined and consumer demand weakened across several categories. Meanwhile, Canada's trade surplus widened to $2.7 billion, supported by strong exports of crude oil, vehicles, and light trucks. Looking ahead, expectations that the Bank of Canada will keep interest rates unchanged through much of 2027 suggest policymakers remain cautious about the growth outlook. For investors, Canada's story is increasingly centered on infrastructure spending, energy exports, AI investment, and deeper economic integration with Europe, even as consumer demand remains under pressure.
Thanks for watching. Remember to like, share, and subscribe. And see you next week.